Hello and, welcome, to the webinar, to learn about, ins and outs of, investing using self-directed IRA. My name is Rashmi. I'm the founder of Arkstone Capital Partners. Honestly, like this is the first of, many webinar series that, I will be hosting. And that's really focused on, like educating investors, generating passive, income. At least for today's, webinar, I'm actually joined with Ramesh, Fakari, Vice President of, the IRA Club. And, he's just brilliant. He'll walk us through, everything that we need to, know and learn about, a self-directed IRA. But before getting into that and handing sort of the baton off to him, I actually just wanted to, if those of you who are wondering, saying, hey, like why this topic, why self-directed IRAs? This is actually super, super special to me, especially because I obviously had, being in a corporate, realm, I've actually changed jobs a couple of times, and I've had IRA, accounts, or my old 401ks that were sitting. I transferred it into an IRA, which was a traditional IRA. And honestly did, that for years, like, or more like decades. I mean, clearly I've been in like corporate for over 2 decades, but it was just, there and didn't do much until, and again, like, just like any, many of us, I would say, your former employers would, either have it through managed by Vanguard or Fidelity or any of the other, companies. And, what's really interesting is I was actually not, I want to say, very active in monitoring this investment category, right? Like, whatever was there, it was, invested in thing every quarter or annually. I would look at it and say, oh, well, great. It increased like, 10%, like there was a time when it went, lower than, 10%. And I was like, oh my God, like what's going on? And there was a time when I lost like 20% of it. Anyway, so it was a roller coaster. And, I obviously saw that until I actually learned about that I could, self-manage, which was a big shift for me, right? Like I've never really, I only monitored it. And now here I am trying to self-manage it, which kind of freaked me out a little bit. But actually, when it came to that, what I didn't realize is there are other sort of, asset classes that I could invest in, which is really what, drew me to exploring it further. And I learned about, self-directed IRA and, then ended up in, I wanted to invest in real estate. For me, that's an asset class that's, like more tangible. So when I explored that and, learned more, I actually uncovered, like just the power of, self-directed IRAs. I mean, if you're wondering, like, why am I so passionate about this? It's really because, like, my first, investment within, I want to say, about 9 months gave me over a 55%, like returns. And I was like, wait, what? Like, how is this even possible? I was literally like blown away. And today, I think, I want to say the first time I invested, it was about, like maybe about, 2.5 years now. And it's over 85%, in returns, and that's what, that particular asset class did. And I was like, oh my God. So really, do you see why I'm so passionate about it? Really something that I wish I had known before, that I, really regret, but very thankful and grateful that I did get the opportunity, to learn about it and take advantage, of the opportunity. And I'm hoping that, many of you are relate to this and are able to do the same. But before, going into sort of the details and handing it off to Ramesh here, I wanted to just, take a few things from a housekeeping standpoint for the webinar. I want to make sure that, we're able to answer any questions, that you guys have. So at the, I want to say, for depending on, like whether you're on the phone or on, the web, on a desktop, you'll probably see like a Q&A bar, and if you have any questions, I would strongly encourage you to add, to the Q&A. And, we do have, time in the end. We want to save to, get through the Q&A and, answer any questions that you guys have. And if there's any specific questions that you have, either, to either one of us, definitely use the chat functionality and, we'll be able to get to that in the end as well. But, with that said, I am going to hand the mic off to Ramesh here. Take it away, Ramesh.
Rashmi, you know what? I love your smile and the enthusiasm that you actually have, because it's the same exact enthusiasm that I talk about when it comes to this specific topic, self-directing. And for those of you that honestly may have heard of it or not heard of a self-directed retirement account, I know we're always referring to IRAs, but the truth is all retirement accounts are self-directed. Your IRAs, 401ks, 403bs, 457s, even a TSP, HSAs, health savings accounts. Remember, self-direction is just a marketing term that we use within our industry. It is actually been always available for, to all Americans, all investors, whether you're accredited or not accredited. The problem is 97% of Americans do not take advantage of it. And that's kind of what we're here to talk about and disclose. As Rashmi said, I will do my best every once in a while to pause, answer some questions. We'll make sure to get before we leave, Rashmi and I both promise to answer as many questions as humanly possible within a productive time frame. Hold on one second. I'm about to share my screen, and just let me know. Rashmi, can you see it on your side? There we go. All right. For some reason, it took a second, but that's what we're here to discuss. Harnessing the power of a self-directed retirement account through alternative assets. Rashmi gave her story about why it's so near and dear, and why she's so passionate. She talked about her ROI, 55%. Over 2 years, it's been 80+%. But that's the goal, right? Is to create double-digit returns within your retirement account. Many of you that may be listening to me for the very first time have, and I'm almost willing to bet that almost out of, wow, there's quite a few participants that we have. I would say about 95% of you have retirement dollars, but just may not be aware of a self-directed retirement account, as I said earlier, or the actual process. But that's what we're here to discuss, right? But before I do, I think it's really important to understand this. And I asked this question even to my own mother and father, right? I even asked this to Rashmi or any one of our clients. What is your number? If you were to stop working today, what is your number? What do you need to survive a day-to-day or the life that you've been accustomed to? The truth is, and these numbers are going to drastically shock you, they're way off what the average American, the average 55-year-old, better yet, needs to be at. It's not even close. The average actual household income actually spends about $67,000. But what's even scarier is it's not that far off after retirement. Most Americans actually retire by the age of 65. So although as many of us would like to retire at 55 or 60 years old, the truth is it's about 65. And the average retiree still spends about $50,000. So I want you to keep that in mind when you're thinking about retiring. How much money do you have saved or in a 401k or invested passively, right? The name of the game for Rashmi and me is passive income, because cash flow is what? Always king. But if you don't have $1.2 million saved, and this is, by the way, stats at the age of 65, you literally cannot retire, because the truth and the fact of the matter is everything goes up. We are in this right now. This is a clear indication that we are in inflationary times. So think about this. If you are somebody or know somebody that just retired in 2020, yeah, 50,000 was what you needed. But fast forward to 2050, you need 118,000, because that is where inflation is anticipated to be. But what's scary is I just told you we're at 67,000 year after year today, which means we are already at 2030 numbers. If you don't have from now until 2040, $2 million saved, you cannot retire. So for those 30-year-olds and 40-year-olds that are listening to this is what I want you to pay attention to. How safe is your retirement account today? Because this is the truth. We know that the stock market's volatile, going up and down. Yes, there was a bounce back last year. I think the official reports actually, Rashmi, have not come out, but they're saying it's somewhere between 6 and 8% inside your 401ks. So there was a slight bounce back, but from the year prior, it was more than 20%. So what that means is you're still behind the 8 ball. Taxes are on the rise. Remember, the US, this is a progressive tax system, which means it will go up. Taxes have never been lower than where we're at currently. Understanding that every single government program that we have across the board is completely in shambles. In fact, for the last 2 years, we have dished out $2.2 trillion between Medicare, Social Security, Medicaid. Again, these are not sustainable numbers, and something has to give at some point, especially within Social Security. And those are the things that we can't talk about according to the Secured Act 2.0, but also inflation. By the way, the inflation number has dropped down to 3.21. They're still obviously trying to get it down to about 2%. Mr. Powell thinks, quotations, thinks we're going to see about 2 to 3 times this year where they're going to cut back on the interest rates. I don't think it's going to be 3 times. It may be 1 to 2 times. And I think it's going to happen much later in the year because all economists are basically showing the CPI reports are not where they want them to be. They're still in going in a pattern of an upwards trend. So these are things that I just want you to be aware of. The one thing, knowing that all of these factors are working against your IRAs, your 401ks, your 403bs, your 457s, and so on, any qualified retirement account, is you have to diversify your portfolio. Exactly what Rashmi did, exactly what I do currently, because that is who the IRA Club is, all right? I'm not going to talk too much about myself just for the sake of time, but I do want you to know who the IRA Club is. And many of you that are listening right now have 401ks, have IRAs, as Rashmi said, within Vanguard, Fidelity, TD, Schwab, or one of these other 10,000 brokerage firms that are out there. So when the best analogy that I always like to give is when you think of IRA Club, I want you to think of those companies, those 10,000 brokerage firms that are out there, okay? So what are the differences? Real simple. Your IRAs and 401ks are probably invested within stocks, bonds, mutual funds, and ETFs. IRA Club has those options for you, but we also let you diversify into alternative assets like real estate, land, syndications, private equity deals, precious, anything your heart desires outside of 3 things. There's only 3 things that you cannot invest in. Collectibles. Sorry, you can't get that antique car or that awesome bottle of red wine or that awesome rug or that painting. An S Corp, you cannot invest in an S Corp, obviously for tax reasons. You're already getting the tax benefits. The IRS will refer to that as double dipping. And 3, your own life insurance policy. Those are the only 3 things that you cannot invest in, all right? So IRA Club, just like those classical brokerage firms, we are a full administrator. You direct us to invest in what you know and understand best. Established in 2008, we have currently open and funded over 12,000 accounts. Full disclosure, we're actually approaching the 13,000 marker, another milestone. We have over $1 billion assets under administration. We have helped educate over 250,000 individuals, literally one-on-one in the last 16 years, whether those live events or not. But the focus, again, is diversification. And I hate to say this, the real people that actually do self-direct are the top 1 to 2% of Americans. This is the actual Yale model, okay? This is how investors invest in the past 20 years. This is a diversified, because that's what we educate individuals on, a diversified portfolio, but not only your personal funds, but also your retirement funds. That is the reasons why it is so crucial now more than ever to diversify your retirement portfolio. If you take a look at the last 20 years, please forgive me. Stocks 30%, private equity, syndications, lendings typically 30%. Hard tangible assets like real estate are 30%. And traditionally, individuals, millionaires in particular, leave about 10% in cash reserves for whatever reason or another. But when I just talked about investing, diversifying, right? Most of you that are listening, if you have an IRA, a 401k, a 403b, or any qualified retirement account, 93% of your money sits within the stock market. All your eggs are in one basket. Do you think that's the smart thing to do? Because one thing that I will tell you is numbers don't lie. If you take a look at the last 20 years, now, the purple box is an individual's home, and this is how much it's appreciated, right? If you own your own home, about 200%. If you look at the S&P 500 and you invested in the S&P 500 20 years ago, your $100 or $1,000 or whatever it is that you invested 20 years ago would have given you a 321% return versus real estate, a 2,100+% return on your money, passive income. Why do you think IRA club members, our clients, diversify their retirement portfolios in real estate? Not that we have anything against the stock market, but where are millionaires made? In real estate, passive income. This is what I want to drive home because this is exactly what IRA club clients do. In fact, if you take a look at the last 5 years, this is in the actual portfolios of IRA club members for the last 5 years. Bonds, oil and gas investments, look where stocks are, 15%, real estate's 35%, syndications and private equity deals. I'm going to show you how to accelerate it and the reasons why it's such an underutilized tool. Rashmi knows this. She's seen me speak at other events. Not to say that I am a professional speaker on stage, but I do travel all over the country, probably about 120, 130 days out of the year. I have a team of 5 that travel all over the country. And when I ask an individual, or the audience better yet, let's just say there's 1,000 people there. How many of you have a retirement account? I'll tell you 95% of the room will raise their hand. The next question is, how many of you heard of a self-directed retirement account? Here's what's great. 50% of the room now will raise their hand because the majority of the people in the rooms are investors. How many people actually self-direct? It's still less than 3% of the room. So it dawned on me, why is that? So these are the 4 reasons why I hear every single time why people are not self-directing. It's number 1, it all starts off with lack of knowledge, financial literacy. I'm sorry to say this, you have to educate yourself. And most importantly, it's taking educated, calculated risks. You got to take risk at some point in your life. You have to do that within your retirement account. You cannot be dependent on those 6, 7, 8% returns on what the market's going to be offering you. 2, and this is very tough for me as an employee of IRA Club, I cannot choose the investment for the investor. Americans have a very hard time identifying investment opportunities. That is number 2. And understanding who is taking all of the risk. It's you, the investor. When you have a 401k with your employer, who's taking all of the risk? You. The only time that you get paid, think about this, the only time that you get paid is when the market is up. If the market is flat or down, are they still taking their cut or their percentage or their fees? Absolutely. Which leads me into fiduciaries, brokers, and registered investment advisors. Full disclosure, we have over 1,000 registered investment advisors that utilize our services. It's because they're listening to their clients, and their clients are saying, get my money out of the stock market. I would like to diversify my retirement portfolio. So when a registered investment advisor calls us and says, can you do this? What do you think we say? Yes, 100%. But if you are working with a broker or a fiduciary, we're going to get into this a little bit later. They create something called artificial restrictions. I'm sure after learning this, or if you guys find an investment opportunity, let's say a multifamily investment opportunity or a syndication, and you walk up to your broker and you say, oh my God, I was at this event, or I just talked to Rashmi, I talked to Ramiz, and they told me that I could use my money to invest in this alternative asset, what do you think that fiduciary or broker is going to tell you? No, you can't do that. That's a prohibited transaction. Or, no, sorry, that isn't part of the portfolio, but here are some other investment opportunities that are comparable to it. And what they're going to try to do is put you in a publicly traded REIT that historically gives 2 to 3, sometimes 4%. Are you going to retire on that? No, highly unlikely. But I want you to understand the history and why it was hijacked, because it all starts off with the IRA. Established in 1974, I want you to understand all retirement accounts stem from the IRA when it comes to investing. All the rules and regulations are all the same. Why they came to fruition? Because back in 1974, Congress, the Treasury Department noticed less and less pensions were being offered. In fact, in 1974, 54% of companies offered some sort of pension. Today, that's less than 5%, 4.6 and some change. But what they didn't take into consideration is every government program that I just mentioned earlier being completely destroyed, starting off with Social Security. Think about this. Established in 1935 as a government program to help individuals, once they retire, to have something inside their pockets. But here's what's hilarious. The average American only lived until 56 years old back in 1935. So you never even qualified for Social Security, but it backfired. Why? If you fast forward today, there are 24 retirees for every 2 workers. Think about that. 24 retirees. I'm so sorry. There are, yes, 24 retirees for every 2 workers. That number is going to close 2 to 1, or sorry, 1 to 1. No, I completely, Rashmi, forgive me. I'm referring to 1935. There were 24 workers for every 1 retiree. Fast forward to today, that's 2 to 1. They're estimating by 2030, that's going to be 1 to 1. What does that mean? That means that they have to address Social Security before the end of the decade, whether that's them increasing the age limit or tax it or get rid of it, which, by the way, will never happen. That's not going to happen, but something's going to give at some point. And it's a gift. Dennis Blitz, president of IRA Club, refers to self-directed retirement accounts as a gift. I just think it's the most underutilized gift for Americans, for investors, because they just don't understand it. Because the true benefits behind self-direction, as I mentioned earlier, is control, giving you the flexibility to invest in what you know and understand best. I'm going to get into flat fee models a little bit later versus percentage-based models, but the icing on the cake for me is tax-free or tax-deferred growth, because every IRA club member is thinking in the back of their heads, how do I get rid of this greedy SOB? I didn't want to say the actual word, sorry, Rashmi. But how are they trying to get rid of this SOB? Because the truth is, more than half of what you make in your life will go to this man, to the IRS. And that's the beauty of self-directing, because what you don't know, it's not just about the federal tax rate. It's all taxes across the board get wiped out when you use your retirement account to invest in alternatives. So if I live in Chicago, the great state of Illinois, most corrupt state, don't laugh. But if you're talking about 6.25 Medicare, Social Security, and health insurance, so right off the bat, I'm eliminating 4.5%. You have to decide what federal tax bracket you fall into, because you are the only one that know your true numbers. I just so happen to be in the highest tax bracket. So I'm thinking all the time, how do I avoid Uncle Sam? This is a strategy. This is a tool. But I want you to see the difference when you use your personal dollars to invest using tax deferred versus using tax-free dollars. Because if you use traditional or Roth dollars, you accelerate your wealth 25 to 50% faster. Let's break that down. Assuming there's an annual rate of return, 12% year after year, 10 years here at the IRA Club, because I like to look at things decade by decade. And let's just say you decided to move over $100,000 from Fidelity over to the IRA club. Take a look at what your personal dollars would be at 349 versus your traditional dollars being 401 versus your Roth dollars. I am a huge advocate of Roth because you still, with your personal dollars, your ROI is not 12%. It's 9% because you got to give a piece of that to Uncle Sam versus traditional versus Roth. After a 10-year span, your ROI jumps to 24%. Unless you're finding deals like Rashmi, 50, 80%. God bless. Because this is what I want to drive home. Who's in the driver's seat? Not you. You have never been in the driver's seat. And that's our job, is to educate you, because 97% of Americans, of the $34 trillion that sits within retirement accounts, it's left within three places: banks, annuities, and the stock market. Now, for the sake of time, I'm not going to get into banks and annuities, but bank CDs were the first to capitalize on the IRA. Their product was the CD. I think I looked at, like, recently, a couple months ago, Goldman and Sachs has got like a 8-month CD for like 5%. The reasons why I really don't care for CDs in full honesty is because it's simple interest versus compound interest. That's the name of the game: compound your dollars, right? Versus annuities. There are two types of annuities: variable and fixed. I will tell you this: fixed income annuities have never been so hard targeted, so hard marketed to between the ages of 50 and 60, because those individuals are the ones that are thinking about retiring. And what their brokers or financial advisors and what they're saying to them is, hey, or going to their HR departments is, hey, I'm scared right now of the stock market. What's another option for me? Well, guess what? They could throw it into an annuity that's going to give you, on a national average, somewhere about 5.5%. Okay. Can you do better than 5%? Please shake your head yes. Thank you. But 93% of your $34 trillion sits within the stock market, historically giving you about 6 to 7% in the last 15 years. And who controls it all? I refer to them as the four horsemen in our industry: Fidelity, Vanguard, Schwab, and TD. Now, Schwab and TD did merge, but Fidelity was the first to capitalize. This is a privately owned company. They just announced that they are managing, this is a scary, scary number, $15 trillion. A third of retirement accounts are held with Fidelity, followed by Schwab and TD, then Vanguard. It used to be Vanguard before they merged. Now, the official numbers for 2023 have not come out yet, right? Obviously, because we haven't ended the first quarter, but the official numbers for 2023 have not come out yet. These are the numbers according to Fidelity. Okay. If you look at 2022, the average 401k, IRA, 403b had 135, 130, 115. By the end of the fourth quarter of 2022, that dropped 23%, 20% within an IRA, and 19% within a 403b. What do you think? And let's look at these numbers. 2022, these are the numbers that Fidelity gave you. Take a look at IRA club clients. This is the average of an IRA club client. Full disclosure, excluding minor accounts. Anybody under the age of 18, I do not include them. So an IRA club client was 253. Fast forward to 2023. Fidelity says your IRA 401k dropped 20 to 23%. Why did the IRA club clients' numbers go up and not down? Simple. They're in control of their retirement dollars. I showed you that graph earlier where they just shifted their money out of the stock market into an alternative investment. Because I need you to understand the averages. When you look at the stock market from 1929, when it came to fruition, to 1979, there's nobody that's listening right now that has a retirement account from back in 1979 between this period. Not even if you have an RMD, okay? Doesn't exist. But I want you to see the average rate of return during this time frame. Fast forward to 1980, 1999, wow. The average return was 14.32%. Why do you think I highlighted this specific box? It's because in 1978, that's when the 401k was introduced to the American people. That was the best time to have a 401k from 1980 to 1999, because that's when the stock market started gaining traction. You fast forward the next 20 years from 2000 to 2022, you're right back down to 5.63%, because this is what we were taught as Americans growing up. Go to school, get a job, open up a 401k, take the employer match. This concept no longer works. You will never, I promise you this, you will never retire on this 5, 6, 7%. You need to be able to create double-digit returns, because the truth is these plans don't benefit you. They benefit the employer, the brokerage firms. They're designed to do one thing, and one thing in particular: control, taking the control away from you and empowering them. And I'm not going to get into actual names, but you guys could read between the lines. Now, here's the one thing that I want you to be aware of. As of recently, the last 2 or 3 years, Fidelity, Vanguard, Schwab, and the other 10,000 classical brokerage firms that are out there are telling their clients, hey, you don't need to move your money over to IRA Club. You could actually self-direct with us. What they're telling you is you could go pick your own stocks. But if you ask them, can I go buy that house on 123 Green Street? What do you think the answer is going to be? Nope. Because this, to me personally, is one of the most important slides of this presentation. There have been a total of 13 recessions in the past 50 years. I'm not going to get through all of them, because none of us obviously were here long enough to experience it. But I will say this, Rashmi, do you remember 2008? I think you were alluding to it, where your IRA or 401k that you had lost half.
Yeah.
So picture this. If you thought that you were going to retire at the age of 60 and that was your goal, and you were just at that cusp in 2008, and you lost half of your retirement money, do you think you were able to retire if you had a $500,000 401k and it just went to $250,000? Nope. You had to work an additional 4.3 years of your life just to get to that break-even point. Fast forward to today. We know in 2022 that the market lost 20%, in particular the S&P 500. So I told you that there was a bounce back of, the official number hasn't come back, but somewhere between 6 and 9%, 7, 8, 9%, all right? You're still have another 12% to go this year. So what I'm saying to you is you just gave up a minimum of 2 years of your life if you had an employer's 401k. Just food for thought. I don't know where 2024 is heading, but it sure does look volatile right now. And that's for you to decide. That's not for me to decide. Because these are the numbers that don't lie to us here at the IRA Club and to Rashmi, because she clearly gets it now. There are 64 million IRA accounts across the country, of which only 1.8 million of the 64 million accounts have $1 million or more. So my question to everybody listening is, what are the 60 million IRA accounts doing wrong that the 1.8 million accounts doing right? It's real simple. They're just in control of their retirement. They're in control of their retirement dollars. That's it. Let's talk about fees real fast, 5 minutes. Employer 401ks, 83% of them sit within mutual funds, because that is their definition of diversification: large, small, mid, international stocks, and bonds. That is not my definition of diversification. Real estate, land, syndications, the stock market. I did dabble in crypto. I got crushed. It's okay. But I didn't, invest at the right time. But to each their own. I'm risky by nature, but I want to go back to these fees. Within the first 5 years, as I mentioned, 83% of 401k employer accounts, or employer plans, better yet, sit within mutual funds. These mutual funds have the highest fee-based structures within the first 5 years of a national average of 4.2%. That's a scary number to think about. 62% of employees have no idea where these fees are, and 18% of Americans actually know how to read them and know where to find them. And actually take that back. Every single one of you that's listening, I want you to go to your HR department and ask them to disclose all the fees, not the expense ratio fees. I want you to disclose the hidden fees. What are the hidden fees? Here they are. Take a picture of this. They're always worked into the statements, and they're going to tell you, we can't find them. But trust me when I tell you, they tack up to be somewhere between 3 to 4% every single time. And I'm talking about, in particular, employer 401ks. When you look at the national average, it's between 1 to 3%. I'm talking about all qualified retirement accounts now, not 401ks. I'm talking about IRAs, 403bs, TSPs. TSPs, by the way, have the best fee-based structures by far and away. Okay. But you only have 5 options. With that being said, it's 1 to 3%. Why am I bringing this to your attention? Because IRA Club is a flat fee model. We don't believe in percentages here. I don't care if you have 10,000, 100,000, 1 million, or 10 million. The most that IRA Club per account can make off of you is $195 to keep it IRS compliant. You're going to ask me, wait, how does IRA Club even make money? It's per asset. If you invest in a syndication, private equity deal, crypto, anything outside of a hard tangible asset like real estate, it's $135. So think about it. If you had $100,000 at Fidelity, Vanguard, Schwab, or TD Ameritrade, we're going to run the exact same numbers strictly based on fees, the flat fee model. 10 years, as I like to do everything decade by decade. If you had an annual rate of return of 12%, Rashmi, is 12% a really reasonable number to hit in a 10-year grace period in real estate? I'm just asking.
Is that reasonable, you're saying?
12%. Is it a reasonable number to hit?
Sure.
All right. I like to be conservative. Let's be conservative.
Super conservative, right?
I like to be conservative because the name of the game is double-digit returns, not your 6, 7% returns in the last 10 years or 15 years, but I want you to double that. IRA Club fees I mentioned is $300 versus Fidelity, Vanguard, and Schwab, or any one of the other brokerage firms that are out there. It's between 1 to 3%. What did IRA Club save you just on the fee structure alone? $83,000 at 12%. But imagine if you made 14% or 16% returns on your money, $111,000. This is not my money. This is not Rashmi's money. This is your money that they're taking from you. Just think about that. Fees are what eat you alive. So what do we offer here at the IRA Club? It is a full white glove experience. I believe so. Rashmi, I don't even think you know this about me, but I come from the hospitality world. I actually own 4 restaurants in Chicago. Better yet, did own 4 restaurants in Chicago. But I opened them, I put them, the concepts were always mine. And then every 4th or 5th year, I would sell it off to a restaurant group, whether it's like Mia Francesca's or Let Us Entertain You and so forth. But I live, eat, and breathe customer service. So that's one of the things that I brought over to the IRA Club, a true system of checks and balances. The whole concept for me is most Americans do not understand it. So if they don't understand it, why would you do it? So the point I'm trying to make is every single one of our clients is assigned an IRA Club specialist. We're not a call center. When you call, I want to speak to so-and-so, right? I don't know what paperwork to fill out next. I don't know if I'm causing a prohibited transaction. If you do not know the answer, you call, you email. We'll respond back on the next business day. That I promise you. If not, you have every right to schedule a call with me so I could go, excuse my French, kick some ass for you. Okay? So that is my whole forte is customer service. I live, eat, and breathe customer service. But remember, your money is FDIC insured, just like Fidelity, Vanguard, Schwab, or one of the other classical brokerage firms. Okay? We do your filing for you, the 1099-R, the 5500 forms. We keep everything up to date within the rules and regulations of the IRS. I'm going to talk about Investors Row real quickly. But remember, the flat fee model is where you win the most with us, not just the simple fact that you could invest in what you want. Okay. But we also remember, I don't have anything against the stock market. We just know how to use it to our advantage here at the IRA Club. All right. So let me give you an example. Rashmi, if you had a multifamily investment option, right? And the dividends are coming back, or rental income, right? If you have a house on 123 Green Street, the rental income's coming back, right? Well, a lot of our clients ask, well, what can I do with this 2,000, 4,000, 5,000? We have a trading platform. I don't want your money sitting here. Let it go work for you. And by the way, that 135 asset fee, we don't charge anything if you want to use our trading platform. Talk about a win-win situation.
I think that's powerful, right? Like, especially if you want to diversify,
100%.
Yeah, for sure.
1,000%. It's like, why leave your money here? Go ahead. You want to do the stock market, do stock. Now, keep in mind, if you're looking for all the bells and whistles and candlesticks and, because I will tell you, we are the first self-directed IRA company to offer an AI platform, true AI, artificial intelligence. We actually teamed up with a tech company called iFlip. We paid a fortune for this for our IRA Club members because, again, I don't want your money sitting here doing anything. But the AI smart folios are fantastic. It's a great way to protect you against risk, although every investment's got risk. I don't care what it is. But it's there. It's an option. That's the goal. And what does it look like? Or better yet, what does the process look like? Open Fund Invest. Really, that's what it is. Open Fund Invest. It takes less than 10 minutes to open up an account. All you need is a government issued ID, your beneficiary's information. Always make sure that you add a beneficiary to your IRA or 401k or HSA, and your social security number. That's it. Those are the three things that we need to open up an account. 2, fund. There's 3 ways that you could fund. You make a contribution. The contribution limits are $7,000 for 2024. Keep in mind that you could actually make a contribution for still 2023, but it's $6,500. Okay. It did go up this year, an additional $500. If you qualify for a solo 401k, my recommendation is to open up a solo 401k. It is much more powerful than the IRA, but the truth is less than 10% of Americans qualify for a solo 401k. So we really don't talk about them as much. Okay. And lastly, time to invest. Just choose your investment. And by the way, there are investment opportunities out there for as little as $2,000, $1,000. There's a lot of Reg A offerings that are out there, Reg CF offerings that are out there. So this appeals to both accredited and non-accredited. Or throw it inside one of our AI smart folios. Rashmi, one of the things that me and you talk about is practice what you preach, right?
Yeah.
It's not, for me, it's not just about the education. I want to put my money where my mouth is. Educate yourself first. I will give you a free IRA account the first year, okay? In order to give you at least a full solid year to find an investment opportunity. So all it takes is an hour or 2 of your time, like on the weekend. I promise you, they're out there. Talk to Rashmi. She'll tell you what to do, where to go. I just can't do that for you, okay? And how do you get a free IRA account? Promo code. What's the promo code, Rashmi?
Yeah, Arcstone right there, bold. Just use the Arcstone, promo code to get your 1 year, free, which is so powerful. I remember, talking to him about it, and I was like, like, why didn't I know about this way back, right? Because I mean, if I have to get into the specifics of how much I paid and all of that, it's for another conversation. But for sure, it's just so powerful. Not just, I think, the platform, but some of the convenience that you guys have on the platform. I think it's super powerful. So
yeah, it's honestly, Rashmi, it's really, you said it best. It's convenience, it's tech, it's how user friendly is it, right? In fact, if you did scan that QR code, it will take you straight to this landing page to open up the account. Like I said, it takes 8 to 10 minutes. There are some great resources. Why Self-Direct, Retirement Calculators, this great guide that I recommend everybody reading. You could definitely contact any one of our team members. And there's also this great, here's the promo code again. There's this great resource center, which you guys are more than welcome to also watch videos on. But again, it all starts with you. All we could do is educate at the end of the day. What you decide to do from beyond this point, there's not really much that I could do. But if you want, again, to schedule a call with us, you're more than welcome to. Rashmi, how are we doing on time? Can we just quickly go over
Yeah,
Investors
sure.
Row?
We have about 13 minutes before we
Okay.
wrap up. So
I'll
we'll,
just 3 minutes. I'm going to talk to you. So every single client that has an IRA club account also has access to our platform, Investors Row. What is Investors Row? It's an educational hub for you to discover investment opportunities. And by the way, it was tailored for both, not just accredited investors, but non-accredited investors. The only advice that me or any one of my team members could say to you is choose investments you know and understand. Okay. If you don't know anything about oil and gas, please do not invest in oil and gas because you won't even know what to ask this company. Make sure you do your research before you jump into that. And just simply put, right? I'm willing to, and I sometimes say baby steps. 2,500 to I don't want to go more than, sorry, forgive me. I don't want to go more than 25,000, let's say, or 50,000, let's say, okay? And that's what I'm willing to afford to do. And then let's just say I'm interested in real estate, private equity, notes, anything of that nature. And you hit apply filters. And these are the companies that would pop up. Okay. Knowing that the investments are somewhere between 2,500 and 50,000, it will be your job to cipher through them, but you could see what they specialize in. So for example, even if you want to get even more detailed and hit hit non-accredited, right? Maybe some of you listening are non-accredited and you guys hit search. Well, it gets even more detailed. These are openings for non-accredited investment options. So all you got to do is literally, like say, for example, if you click on Spartan Investment Group and a disclaimer is going to pop up saying you're doing this at your own free will. You're going to educate yourself. You're going to learn about the companies. Here's the quick overview. Their strategies, details about the company, direct access to them. This is the actual fund. So the beauty of Investors Row is you could make the investment straight from your IRA club account, straight into the actual fund itself. It's going to give you a breakdown about what the investment details are, rate of return, minimum investments 50,000, their BBM, their subscription agreements, their videos. Educate yourself. They're out there. And by the way, you're not limited to Investors Row. I don't care if you go on the World Wide Web, and I'll be honest with you, I don't care if you go knock on your next door neighbor's house that's got a for sale sign and you want to use your IRA to buy it. It's just you got to diversify your retirement portfolio. That's what I firmly believe in. But like I said, there are investment opportunities for as little as $2,500. And here's the best part. You could actually make the investment. You have to be an IRA Club client to access your IRA to invest directly into here. By executing this form, you acknowledge IRA Club has not made any recommendations or advice, and it'll take you straight into our banking CRM. All you need is your IRA account number, government issued ID, and if you are accredited, your accreditation status. That's it. First name, last name, IRA account number, how much you investing, upload your accreditation status and your driver's license, submit. You made the investment. Congratulations. So our platforms are very easy to use, not to mention the trading platform is literally right here for you. So there is a cost. So remember, the asset fee is zero. If you decide that if you want to go pick your own stocks, your own ETFs, absolutely for free. But if you want to choose a smartfolio, what I negotiated for IRA Club clients is a flat fee model, but tiered. So from 0 to 10,000, $7 a month, 10,000 to 25,000, 17, and go on and on. But the beauty of it is I capped it off. So $100,000 or more, 100,000, 200, a million. What's the most that they could ever take from you? $1,600. Because Fidelity, Vanguard, Schwab, I promise you, they're taking on a national average between $1,200 to $1,500 in that ballpark for every 100,000. So with this, you don't care if the market's up, down, or flat. What's the most that they could take from you? 1,600. Anyways, I hope all of this makes sense. We'll open it up. Rashmi, I'm going to pass it along to you.
Yeah, no, that was
32 minutes.
That was awesome. Just, like a lot of information. Actually, going back to that, slide that you had, I mean, not the slide, but, where you were showing, Investor O and how to go about, um, investing. There's a question here, which, which is about how long does it take for accounts to be transferred to the self-directed account?
Great question. It all depends on the custodian. Okay. Remember, they're trying to hold on to your money for as long as humanly possible. Something that IRA Club has that most 95% of self-directed IRA companies, by the way, there's only 26 companies that do what we really do. Okay. And of the 26, 10, I would say, offer what IRA Club offers outside of the trading platform. We are the first self-directed IRA company to offer an AI-driven platform. So we're very excited about it. We paid a fortune for it for our clients. But it all depends on the custodian. And we have something called an ACAT system. For those of you that don't know what an ACATS is, and you may be more familiar with what wire transfer and ACH, which is the movement of funds. And ACATS is the movement of not only just funds, but the movement of securities, which means IRA Club can go after an old employer 401k where 95% of my industry cannot. And that's because we fully integrated into a clearinghouse, which again was a fortune.
Yeah. No, and personally speaking, right, to your point, I think it is so dependent on, the custodian that you're dealing with. But for me, personally, I believe it was, under a week,
Yeah.
since I initiated it. But then, then I'm dealing with all of the other, oh, we can only send it via this. And,
Yeah.
just so I think it's also just dealing with, also the recipient custodian, right? Like, and yeah,
Oh,
and
trust me.
working
So, some of them want a medallion. Some of them want a medallion stamp. Some of them will only send a check. They
yeah,
won't wire it because, again, they're trying to delay. Remember, for every day that goes by, and let's say you had $250,000, for every day that goes by that the money's still held within that custodian or trust company, they're making money off of you.
off of it. Yeah,
Remember
that's
that.
true.
So,
Yeah,
so it depends. I've seen it go as long as I hate to say this, like 6 weeks.
yeah.
Um,
Well, I think I did it. My first one was, I want to say with one of them was with Vanguard, and that took the longest. Yeah.
I listen, I hate to say that. We'll do our best. We have an actual transfers team. Literally, I have like 3 people on the phones all day long, trying to get there. In fact, I'm going to say this to everybody who's listening. Fidelity, Vanguard, Schwab, they hate IRA Club. They do not like IRA Club. So they make it very hard for my transfers team to go after your retirement dollars. In fact, a new rule that Fidelity and Schwab and TD just announced is you are not allowed to call them until after the 10th business day that the IRA to IRA transfer was initiated. So think about that. They don't even want us to call for 10 business days, which is ultimately 2 weeks.
Yeah. There's actually another question here. If there's any advice on the use of self-directed IRA to invest in, buying flips.
Oh yeah. So just be careful with that. And I'll tell you why. If you like hypothetical, let's just use it. Let's just say this is a house that you want to flip, okay? And you buy it for $50,000, hypothetical scenario, but you know that it needs $100,000 worth of work. That means that $100,000 worth of repairs doesn't come from your personal dollars. It comes from your retirement dollars because you didn't purchase the flip. Your IRA purchased the flip, which means it reaps the benefits when you sell because it's tax-free or tax-deferred growth. You can't use your personal dollars to fix the house on 123 Green Street. Also keep in mind, you can lend to do flips. There are, if you go to our resource center, and there are some non-recourse lenders that are on there. But I want you to understand what UBIT or UDFI is. but these are some actual lenders that we personally deal with. The first four actual trust companies, Red Rock Capital is a private lender. A lot of our clients use them. But keep in mind, because they specialize in IRAs and 401ks, but the interest rates are so much higher when you borrow against an IRA or 401k. And that's any one of them. And they also typically want a higher down payment. So they usually ask for 50, 40, 50, sometimes even 60%, because it has to be structured as a non-recourse loan.
Yeah.
And you will trigger, as I mentioned, UBIT. And I highly recommend, that's a whole nother topic of discussion, Rashmi, that could take me over an hour to talk about UBIT and how to calculate it. But you need to
No,
be aware of that
that's true. Definitely. Is there
if you're
other
leveraging.
resources, that if people wanted to look at it, a little bit further, are there resources that are available?
Yeah, I'm sorry, what was the question? My
Yeah, no,
apologies.
I wanted to know if there were resources available, on the platform, if they wanted to go look up, the UBIT and, just learn a little bit more about that.
Oh, absolutely. So for clients, we have our forms and guides. So like literally, if you just click on guides and hit, oh, sorry, not clear filter, but just hit enter guides. Oops, I think I made a mistake. Investment accounts. So it's in alphabetical order, but this is how to calculate UBIT and
Yeah.
UDFI. This is a great detailed read about UBIT if you're planning on leveraging against your IRA, but these are the actual calculations that have not changed. So think about that. If you're leveraging and you're making a net profit, let's just say between 2750 and 9850, right? You're going to get charged a UBIT tax of 275 plus an additional 24%. So sometimes UBIT is not worth it. So if you're planning on leveraging at 11% and then getting hit with a UBIT tax, well, what's left for you or your IRA? So sometimes it's not worth it. All right. Now, if you're doing, but I want to bring something to your attention to the individual that talked about fix and flips. If you could buy the asset, fix it with your IRA, leverage, fix it, and sell it within one fiscal year, you will not trigger UBIT. And you could do that up to 3 times.
Yeah.
And my recommendation to do that is on the start of the new year. So I would not do a fix and flip, let's say in October, November, knowing there's only 2 to 3 months left in the year. So I have seen that done quite often too.
Yeah. No, that's great. Thank you for sharing that. I know we're, at the top of the hour, right now.
Yep.
I want to be respectful for everyone's time. It has been, and yours, my God, thank you, thank you, thank you. This was,
Thank you.
awesome. I'm hoping that everyone found, this useful, just learning about different asset classes and, being able to sort of, take action on, sort of going back to their own goals and, looking to see how they can diversify, money that's actually going to work for them later on. So if there's again any questions for I know there were some questions on just recording. There will be a recording of this that will be shared as a follow-up. But again, if you guys
I
have
also
any questions, go ahead.
I'm so sorry, Rashmi, I didn't mean to cut you off.
No.
I actually put so I want people to have access to the free IRA account the first year. And if they just, there's a great resource in there. I think I was sharing that, but I put it inside the chat just in case you guys didn't have time to pull out your phones. But I put it in the chat. So if anybody wants when you guys talked about a resource center, here you go. And this is a really good read about self-directed retirement accounts. It's a 14-pager, but it really goes over high level everything that I talked about.
Yeah, no, absolutely. Thank you.
You're welcome.
Yeah, with that said, thanks again. If there are any questions, feel free to reach out to us. Happy to help, and enjoy the rest of the day. Thanks for joining us.
Thank you.